Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jarod Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. I am your host, Jarod Alexander, and today I'm super excited to have my guest on the show, Trevor Oldham. Trevor, how you doing?
I'm doing excellent, Jarod. Thanks so much for having me on the show today.
Thanks for being here with us. And a little bit about Trevor. So back in 2017, Trevor founded a podcast company called Podcasting You. And now, mind you, this is before podcasts were that popular. And, his goal was to help alternative investment companies build brand awareness and generate more leads and clients through podcasting. Or podcast guesting, excuse me. So for Podcasting You has worked with 400 plus companies and booked 6,500 plus interviews. So Trevor is personally involved in 4 multifamily deals. So some of those are multifamily, self-storage, development, and investing in mortgage notes. So 4 passive deals total, all while continually expanding his real estate portfolio. So first of all, walk us through how you got into this space, what made you want to start a podcasting company, and what led you on the route of investing in multifamily, syndication, self-storage, so on?
Yeah, most certainly. So I would say really the story starts back in 2015. And it was at that time I was running a separate company, not Podcasting, which I run now today. And I was running that company with a partner. And it was actually, from the outside looking in, it was looking pretty successful. It was a motivational based company. So what I mean by that is you go on Instagram and you would see motivational quotes. And that's how we built up an Instagram page. And we had the science down of when to post, what hashtags to use, what images to use. And we grew to about 100,000 followers within 6 months between my partner and I. But we realized, what happens if our Instagram got shut down? Where would we turn to? So that came up with the idea of starting a podcast. So from 2015 to 2017, I hosted my own podcast. No longer run that podcast today as I ended up leaving that company, but did it for about 60 to 65 episodes. And I was the person booking the guests. I was editing the podcast. I was creating the social media snippets from the show, doing the recap. I'm sure, as you know, Jarod, it can be a lot of work going through and very time consuming, but I did all that for about 2 years, learned the ins and outs of the podcasting space. And back in 2015, it was fairly easy to get a lot of good quality guests on the show, a lot of 7 and 8 figure entrepreneurs, because I would imagine that they weren't getting asked to go on a ton of podcasts back then because they really weren't as popular as they were today. But then jump those 2 years after doing this, being in this podcasting space for 2 years, 2017, ended up leaving that company and just started freelancing. And I was using a platform called Upwork, and I would find people that wanted to get booked on podcasts, needed guests for their podcasts, needed help editing, needed social media clips created for them. Basically everything that I'd self-taught myself for the past 2 years, I started freelancing out. And then just, fast forward a couple of years, ended up realizing I could do this more full-time. I could actually create a company out of this. And mind you, this was the 3rd different company that I had started. So it was nice to have one that I was actually making money, and ended up bringing on like the first employee and growing it over time. And then it was back in 2019, 2020, we were really working with any client that we could get our hands on. So whether they were in real estate, whether they were a business owner, whether they were in health. And I realized it's very difficult to work with all these different niches, because every time you work with a different client in a different niche, you have to build new relationships with podcast hosts. So I decided, why not just go forward and go work with one specific niche? And that's where it came to mind, working initially with real estate investors only. And that sort of expanded a little bit more beyond to like your oil and gas folks, your private equity, some venture capital firms as well. So it's basically anything that you can invest in outside the stock market. And it was through that and running that, I really got to get a good insight into, specifically in the real estate space, a lot of these sponsors and operators, how they operate, how they run their company. Do they pay their invoices on time? How are they on a sales call? Different things like that. And at this point, I really had no idea whether or not I wanted to be a passive investor. It sort of came to me one day where I was like, I don't want to be running this company forever. I enjoy running this company now, but I'm investing in an IRA, I'm investing in a 401k. And if you look at those, can't access that money till I'm 59 and a half. I was like, I don't know, I don't want to be running this company for another 30 years. How can I start to create some cash flow from the money that I'm making from the company now? And that's really what took me down that passive route. So I was working with a lot of these clients that were raising capital and were investing in deals and looking for passive investors. But even then, it sort of took that light bulb moment to be like, okay, how can I take the income I'm making now and start to get cash flow from it, start to allow that money to grow outside of the stock market? And that was back in, I believe, in the middle of 2022, and then ended up getting into that first deal, I believe, December 2022 is when I ended up getting to that first passive investing deal.
Awesome. Yeah, thanks for walking us through that. And I'm curious, so did you start when you started interviewing these real estate guests on your podcasting platform? Is that when you learned about syndications and what that process looks like and how it works?
So that actually wasn't. It was actually unique. So when I was working with a business coach at a certain time, and he was like, "Why don't you invest in real estate?" And that was also part of the light bulb moment. I was like, "He's like, you're working with all these real estate investors. They're always looking for capital." Like, I don't know. I've never really thought about it, but I didn't really understand too much about it, other than a lot of our clients work with us because they want to generate more awareness. I didn't understand whether they were accepting accredited or non-accredited investors. So I think I just started on Bigger Pockets and was just looking up how to invest passively, started pouring through those forums. That led me to Left Field Investors, which I believe is now called Passive Pockets. And that's where I know you and I, Jarod, we met, and it was a forum for folks that are looking to passively invest. I started attending networking groups on LinkedIn. It was almost like a fish in the water when I was someone new that had money to invest, and you had all these different sponsors within these groups. But it was a really good opportunity to learn from everyone. But that's really how it got started. And I just honestly just started talking to sponsors. I would try to talk to about 3 different ones per week. And early on, having that conversation, I wouldn't even know what to ask them. I would hop on a call and they'd say, what do you want to know from me? I'd be like, I don't know. What questions should I be asking you? So I was very new, but after about a couple of months of doing that, talking to different sponsors, you start to get a good feel of, okay, I would invest with this person. No, there might be a red flag with this certain individual. And that's really, it was just doing all that self-education. I believe I purchased a course through Michael Blanc. He had an underwriting course. And the best part about it is I had an underwriting analyzer. So I could take numbers from the deals that I was looking at and plug them into it. And within 2 minutes, I would get an idea of whether or not the purchase price on the property was right, or whether some of the other metrics, whether the vacancy or the CapEx numbers are going to be correct. So it's just a ton of self-education to try to figure out, okay, if I'm putting 25K or 50K into a deal, I want to make sure I know what I'm investing in. Where you talk to a lot of sponsors and operators, and it's a lot of times it's very much the same. You know, we have a good track record. Hopefully, I mean, might have changed recently within the last year or so, but a lot of times out here, you know, very conservative. You're going to get this percent IRR. Here's the cash on cash. And I'm like, okay, like, what does the IRR mean when it comes to my risk as an investor? Should I be getting a better IRR based on the risk? Should I expect to get a less of an IRR? And for those listening who may not know what that means, just your internal rate of return, your overall rate of return that you get on an investment. So like, let's say you invest in a deal and you get a 10% IRR. That means maybe the first year you got 5%, second year you got 6%, third year 8%, fourth year 8% again. And then at the sale, that's where you get the overall, that 10% IRR. But if I'm investing in a heavy value add deal, and I'm only getting a 10% IRR, it's really not worth my risk. Maybe I should be expecting a 20 to 25% IRR. So there was just a ton of learning curve that came with it, and it was just a ton of using those forums, reaching out to people, talking to people, reading books, podcasts, and just really undertaking all that self-education.
Yeah. Yeah, no, thank you. And yeah, lots to unpack in there. I'm sitting here jotting down notes is on just key points I wanna touch on. First, I just want to clarify one thing. So when because typically when people get started out in this space, they do dabble into single family and start to, okay, this is a lot of work, right? Being active on the deal. And then they start looking at other opportunities. But it sounds like, based on talking to your mindset coach, you just went right into, okay, hey, let me just start talking to these operators that I'm interviewing and getting on these forums and being a part of these communities of, why not just invest directly with them? You got your company that you're putting, a ton of hours into, right? Because it's,
Mhm.
we both know, Trevor, it's a lot of work owning our own business.
Mhm.
And on top of that, trying to manage a portfolio of single families or be active in these deals or being an operator, right? On a multifamily deal, it's a lot of work. So you jumped right in, right? You didn't start in any single family, and that's just wanted to clarify that. Yeah.
Yeah, no active. Just I realized I just wanted to go fully passive.
Yep.
One, I don't want to deal with the headaches of being a landlord. I think I would be too passive of a person. I'd feel bad if someone's behind rent and to go out there and go through the vacancy process. I'd rather let someone else handle that. And then it was really honestly more of a time commitment where I didn't want to go out. Where it's funny being a passive investor, it sounds great, but I mean there's a very active part, and I know I just went through it and described, talking to people, understanding the deals. But I find that once I invest that money is invested. And yeah, I might make a little bit less of a return being a passive investor, but the return of getting maybe 1 to 2% less on a deal being a passive investor versus being an active investor and having to go out and find the deals and manage the tenants, for me it's well worth it. And so I always just decided I'm just going to go down the passive route. And right now I don't have any interest in being active. I just enjoy being a passive investor. And it's nice because I feel like if I was active and I bought my first property, I'd probably want to stay where I am. Where it's nice being a passive, I can invest with operators all over the country in a variety of different states where I'm not going to get that in my local market. And I know I could invest out of state, but I don't know if I would want to invest out of state on my own as an active investor for the very first investment that I do. I would probably want to invest just in my local area just to get my understanding of how everything operates and just being a new active. So for right now, I just enjoy being a passive investor.
Yeah. Well, and thank you for clarifying that, because I think it's super important for somebody just getting started out in this space. And, obviously this podcast tailors to the passive investment, but sometimes you just don't know. Do I want to be active? Do I want to buy a single family? Do I want to buy a duplex? Like when we finally pulled the trigger on, buying a single family home, we're here in Phoenix and it was hard to find something to pencil. So we did go out of state, 2,500 miles away, on a house we never even saw before, right? That it was turnkey, had a tenant living in there, but for one, it was really scary, right?
Mhm.
But two, after doing that, I put $25,000 on it. It was not even $100,000 house. But once I got into the multifamily space and learned about these syndications, going back to your point, Trevor, I learned that I can put $25,000 or $50,000, whatever it is, into a multifamily investment opportunity, right? A syndication, get a similar cash flow to what I was getting on that single family home on my money, because most of these are cash flowing about $200 a month, right? And then I can still, benefit in the real estate tax deductions, right? The bonus depreciation, the cost segregations they do on these properties, and, be completely passive after I, do that initial wire. You do your due diligence on the front end, right? But after I do that initial wire, I'm completely passive and I'm just getting what they call mailbox money,
Mhm.
right? So I think it is super important, and we've talked about this on the show before. Of all right, decide whether you're active or passive investor. What do you have time to do, and what are your goals? What are the reasons you're wanting to get into this space? Is it to grow your business, spend more time with your family, right? Just become more work optional, right? Have a plan B. Like for me, with my my W-2, it's like I'm 100% commission, right? If something happens to me and I'm not able to make money, right? So just having a backup plan as well. So again, yeah, thanks for that clarification. So I want to go back into, all right, the due diligence on the passive investment, because like you, Trevor, whenever I talked to that first operator, I literally did a Google search on what to ask an apartment syndicator before investing. I had no idea, right? And so like I really didn't know what to expect. Now, I will say, and I felt comfortable with this operator because for one, they answered a lot of those questions without me even having to ask. But two, was the communication. Of course, we look at track record, all those things you had mentioned as well. But after you kind of, found an operator that you liked, what was your, did you, and I'm actually familiar with that Michael Blanc deal analyzer. Mm-hmm. So did you take the numbers and put them in there, and then once you felt comfortable, decided to pull the trigger, or how did that first one go?
Yeah, exactly. So it'd just be taking those numbers, putting those through there, making sure, I felt comfortable. But I would say up front, probably talking to like 30 operators before I invested in that first deal. And I was pretty stringent. And I think maybe I created the Google sheet and I just kept them all on there. And I think out of the 30, I maybe put 6 or
now,
7.
Just to clarify real quick, that's 30 operators that you actually reached out to, not just on the podcast, right? You reached out.
Oh no, these are folks that I'd spoken to, and
awesome.
Okay. And I'm a non-accredited investor, so it's not easy getting all those. I have to go out and find all those different individuals to have that conversation with. So that definitely wasn't easy, but using, like I mentioned before, Bigger Pockets, LFI made it a little bit easier finding these operators. And I think out of the 30, there's probably 6 that I felt comfortable investing with, whether or not they had a deal available or not. And I think early on for me, the biggest thing that I was looking at was the cash flow. I just wanted to get more cash flow right away. And that was what I want. That's what I ended up doing for the first 2 deals that I invested in. Just more or less, just like I never passively invest. It seems like a lot of people are doing it. It seems like a lot of people are having success, but like, to give you an example, when I invested in the first deal, which was with Chris 70 from 70 Investments, I knew that if I put my money in today, and a month from now, I'm going to get my first distribution. So similar to my triple net lease deal that I invested in, same thing, I invest today, and a month I'm going to get that first distribution, where maybe I'm not going to make as good of a return on my self-storage development deal that I'm currently part of, but I put money into that deal in February of 23, and I haven't received any distributions yet. Expected to get the first distribution in January of 25. So there's obviously a long time. And I don't know, as a passive investor early on, if I could have stomached putting money into that first deal, not getting any returns for 2 years, where the projections on the self-storage deal look like I'm going to make I'm going to probably get like a 2.5, 3x equity multiple on that deal, which is better than any other deal that I invested in. But it's also, I have to be very patient on it because I am trusting this operator to go through this whole process. But yeah, going back to those deals that I was looking at, it just did a lot of upfront vetting with the operator here. One would be like, do they show up on time to the call? Whether or not they, that's a big thing. Do they show up 5 minutes late? How is the conversation with them? Like, to give you an example, do they just make it about myself, or do they ask me, what am I looking to invest in? When am I able to invest in? Just questions like that. Like, I've hopped on calls where the person's 10 minutes late and they tell me where they went to college. I'm like, well, that doesn't really pertain to me or my investment. So that's first and foremost. I mean, that's pretty simple. Outside of that, it's how's their track record? Have they ever had a deal that's gone sideways? Have they ever had a capital call? And usually I'm looking for someone where they don't necessarily have to have a capital call, but somewhere in a deal where something was going wrong, or not that they lost money, but they had to fix a situation. If I invest in someone, if I talk to someone and they say, everything's been perfect, we've given you, every investor, 2x equity multiple, in 2 or 3 years, we've never ran into any issues. Well, it kind of scares me because what happens when they do run into issues? And again, I'm not looking for someone to have a total loss or anything like that. Just looking for someone where maybe they have to fire the property management company that they hired, and what did they learn from that? So that was a big thing for me. And then also after I hop off a call with the sponsor, I'd email them over a question and see how quickly they get back to me. Is it a day? Is it 2 days? Sometimes they'd be back to me in a week. Sometimes I'd ask them a question, they wouldn't even get back to me. And I'm, like I mentioned before, using Michael Blanc's underwriting deal analyzer, I would be like, I'm getting the purchase price of 12 million. You're buying it for 14 million. Here's why I think it should be purchased for 12 million. How come you're buying it at 14 million? And just giving them a chance to rebuttal, and then I would just never hear from them. And so that would, and if they could explain to me why they're buying it 2 million more than what I thought, because it was back in 22, it was still able to buy a property back then, and potentially, depending on where in 2022, but buy a property back then and being able to flip it rather quickly or get it for a good value. Maybe some of those deals haven't gone as well now, but it was just a lot of talking to those operators. Some of them would tell me things like, we're going to get you a 25% IRR. And I'm like, this is just your standard, deal. There's really nothing that special about it. I don't understand. I don't see like where I'm going to get that 25% IRR. I'm typically looking on a standard, say, Class B value add multifamily deal, anywhere from 12 to 15% IRR, maybe a little bit higher on that deal. So if you're promising a 25, 30, I've even seen people say a 40% IRR. Well, I know looking at a deal, you can just manipulate the numbers any way that you want. And that's why the underwriting part was key. And it was just, it was just pretty crazy talking to all these different sponsors. And again, some of them, I liked their conversation. I just didn't feel comfortable with where they're investing. Maybe they were investing in California. Like I came across a good operator where they flip houses in California. So it was more of a debt fund deal where you help fund their private investments. But again, California just scares me. The deal seemed good, but I'm not going to invest in California just given the real estate market out there. So it was even small things like that where I'm like, you know what? I don't want to invest in that particular state. I just don't think it's that friendly to landlords. So I'm going to hold off on it, even though the sponsor checks off all those other boxes, just because, again, I wanted to be very diligent when I'm putting 25 or 50K with a sponsor, just because a lot of the times it's almost like a marriage for 5 to 7 years where you're going to be stuck with them.
Yeah. And I would imagine, so out of those 30 operators, right, like that's how you were able to weed down to the 6, looking at market, communication, their deal projections, their business plan, right? Because typically the higher the IRR, right, the internal rate of return, the more risk, right? Like with your new development deal, there's just a lot more hoops you got to jump through, and it can be a lot more rewarding, right? Like you said, it'll be a 2.5, 3x multiple by the time this deal goes full cycle. But these are things to pay attention to and know as a passive investor, right? Anybody can manipulate numbers, like you said, and just make a little tweak here and there to make those projections look really, really juicy. Mm-hmm. But kind of a rule of thumb, especially in the multifamily value add space, you're not looking at a lot of really high cash flow. 5 to 7% cash on cash is usually pretty typical, and it usually starts off lower because it's a value add play where they got to renovate the units, increase the value of the property, which as a result of that, your cash flow goes up, right? And then to your point, Trevor, going back to the IRR, typically you're seeing between like 14 to 17% IRR on most of these deals that I found that we vetted, and we got a 99-point checklist due diligence process that we go through before we even partner with an operator. And obviously one of those is looking at the underwriting and their projections. But, as a result of going through this process, again, 14 to 17% IRR is pretty common, right? And then the, you got the average annual return as well, right? So typically 18 to 21% is kind of what we're seeing right now. Again, these are just based on, of course, past performance and future projections, right? So these aren't set in stone numbers. And honestly, and Trevor, you probably know this too, is whatever the operator is projecting is typically never exactly the return you're going to get. It's either going to be lower or it's going to be higher, right? These are just projections based on information they have and the data they have based on the market, rent comparables, sensitivity analysis, things like that, which definitely gets you in the ballpark. But just know, these are just projections as well. So, it's definitely important to go through this process, Trevor. And thank you again for just walking us through that due diligence, because this is your hard-earned money, right? It takes a while to get $25,000, $50,000 saved up and be able to allocate to one of these deals. So definitely go through and get a part of a community, right? Like Trevor and I are part of the LFI community. That's where we met, and just people that are able to talk about what's going on, learn from, find a mentor, get a business coach. Like I love how you talked about having one of those, and because I do as well. And it's just helping you, for one, making sure you're going down the right path, right? And taking the necessary steps to educate yourself and all that. But I also just pushing it through, because this stuff is scary. So just kind of taking that step is important as well. So there is that balance. Trevor, anything you want to add to that?
Yeah, no, I think that's key. And like you mentioned, I know I've harped on it again, but when you have 25, 50K, definitely takes quite a while to get that money. So you want to make sure that you're putting it in a deal. And if you don't understand the deal, don't put your money into it. I know for me, like that's oil and gas deals where the numbers look very lucrative, but I just don't understand enough about that space to put my money into it. So I'm gonna hold off until I had not that I need to be an expert, but I just want to make sure I have a good understanding. I think that sometimes where people invest in these deals where they just have really good projections and they just invest thinking that they're going to get them, and then maybe the deal doesn't work out or something along those lines. So just make sure you have a good understanding of what type of asset class that you're investing in, whether it is within real estate or you're venturing off, like I mentioned, oil and gas deals, which I don't have any understanding about, but I know that some people can make a lot of money in those deals.
Yeah, that's a good point. I had a guy, I think with Mike Sullivan with Aspen Funds on the podcast, and they have oil and gas deals, and yeah, it's a totally different world. Very lucrative, right? Very lucrative, but there's a lot of bad actors too in that space as well, which could be in any space. So again, just do your due diligence and definitely finding the right operator and somebody that's going to really lay it out to you and explain that whole process. So yeah, definitely great points, Trevor. All right, now, I'd like to go ahead and transition into what I call the fire round. And what we're going to do, Trevor, is we're going to go through 4 questions. And first one being, if you could recommend a book on real estate for investors just getting started out, just dipping their toe into this space, and then another book on cultivating a positive mindset.
So I would say on the real estate side, I would say The Wealthy Gardener. That's been a very good book for those who haven't read it. It's basically, in a nutshell, it's a chiropractor, and he's writing parables to his son through this book, and he ends up building a 200K passive income portfolio through active real estate investing. But it took him, I think, over 20 years to build this portfolio. So I think it's a very realistic, where sometimes I think online we can see people and they say, I grew my portfolio like this amount of units or assets under management rather quickly, where he built it through sheer grit and hard work over these 20 years. So I find that one. Now, the other book that I'd recommend when it comes to just overall cultivating a better mindset would probably have to be a book I read called Endure. And it just comes to mind just because I recently read it. And it's more about how far we can push ourselves as humans. And it's more of a running book. But it talks about whether, like, if you're running a marathon and your legs hurt, is it more your legs actually hurt, or is it more in your mind? And I give a good example. If you're running a marathon and you're mile 25 and a bear comes out of the woods and starts chasing you, even if you're in pain, you could probably push yourself that, the safety by sprinting. But how come you couldn't do that, the previous miles, even though you're still in pain? So it got me really thinking about, like, just about life and how far we can push ourselves and what it means to, the limits that we place on ourselves. So I found that one was fascinating. And they give a ton of stories in the book. I mean, trekking to Antarctica, climbing Mount Everest, to doing these cycling races like the Tour de France. So they bring in all these different types of sporting events and people that have pushed themselves and and seeing their limits. So I recommend that one as well.
Awesome. Great. And then, I got a question on that. So I see the medals behind you. Have you done any marathons or triathlons or anything or?
So I did one sprint triathlon and then I did a half marathon in August, and I have a marathon coming up this Sunday. So started to get into that. And that's why I mentioned that book, because I actually just finished reading it a little while ago. So yeah, I have the first marathon coming up this Sunday. So kind of just really got into it, I don't know, in the last pretty much over the summer, I just started pushing myself doing these events. So yeah, and it's funny. I think in my mind, like a marathon, like I know how difficult it will be, and I'll be like, it's funny to me just thinking like mile 25. I mean, you're pretty be toasted, at least for me, where I'm just trying to complete it and then having that bear run out of the woods. But yeah, no, the goal is to finish that this weekend. Just my goal is I'm not the fastest, but I just want to finish the marathon just running, make sure I don't have to walk, just try to drag my feet along just so I never have to stop. And that's that's really my goal for this weekend.
That's an awesome goal. Well, good luck on that, man.
Thanks.
That's an awesome thing to do. I'm got a Spartan race coming up, a half marathon
nice.
Spartan race with like 30 plus obstacles or so. But it's interesting you mentioned that endure, because I mean it's like, man, I remember the last time I did this race, I was at mile 8 and my knee just gave out on me. Like that IT band center, just couldn't even move it, but all these thoughts go through your head. I'm gonna throw in a towel. I'm gonna, I can't walk no more. And I'll tell you one thing, my son was gonna be at the finish line, and that just popped in my head. I was like, there's no way I'm not finishing this race with my son, sitting there at that finish line. And I'm running backwards, I'm skipping, I'm jogging, I'm, whatever, right? And lo and behold, got there. But yeah, it's so amazing how much goes into the mind and how powerful it is, even when the mind's telling you that the body's just done. It's not. You still got more, right?
Yeah.
But I'm sure, and I would love to talk to you after this marathon, because I'm sure you're going to go through some of that as well. So.
Oh yeah, I'm sure. Even on I did I think I ran up to 20 miles, and even then, like the last mile, like mile 19 to 20, I was pretty hurting. So it'll be interesting to see how the last 6 miles go.
Yeah, it's like I got 6 more miles after that, another 10. Yeah. Oh, awesome, man. Well, and great book. Thanks for the book on the Wealthy Gardener too, because I'm going to check that out. I haven't heard anybody refer to that one before, or the Endure. So thanks for that. And if you could, we might have an answer to this next question here, but if you could share a specific goal or dream that holds special significance to you.
Yeah, I would say for me, it's probably next year where I'm looking to run or do an Ironman. I think just starting early on, just doing the sprint triathlon. And for those listening to the sprint triathlon, it was like a 750 meter swim. It was a 12-mile bike ride, 3-mile run. So you're doing a 5K. And then in my mind, I was always like, an Ironman, that's crazy. In an Ironman, it's like a 2.4 mile swim. It's like a 57-ish mile bike ride, or not, 100-mile bike ride,
100 mile.
And then a full marathon on top of that. So I think that's just that big goal where I'm like, I never thought that I could do, and that's just one accomplishment that I want to have. Just thinking early on when I was training for the sprint triathlon. So the goal is to do that at some point next year. I think I'm targeting June or July, just because I know there'll be a lot of training involved, and there's a ton of training involved just for this marathon. But that's that one goal where, in my mind, I was like, oh, I can never do that. And then as I start to train, I'm like, maybe I could do that. And then now I just want to go through and book it and do it. And just, I know it'll probably be 10 to 12 hours of pain, but, I know I'll come out better on the other side of it.
Absolutely. That's a bucket list thing for me as well. And I've done a sprint and an Olympic triathlon, and just the fact of, doubling like the swim and, the run, it's just, yeah. And by the way, it's not 100, it's 112-mile bike ride.
Yeah, you got to add in those extra 12 miles.
Oh my gosh, yeah. So good for you though, man. That's awesome. So, so how do you structure your day to maintain a healthy work-life balance? I'm going to add in training, right? For these races. I know you have kids as well, right? And so, that's the first question. How do you structure that balance there? And then do you have a morning routine that you can share with us?
Yeah, most certainly. So I'd say going through the structuring aspect of it, where I'll go through the work part of it, and then I'll go through the training part of it as well. But what I do for work is I use an app called Before Sunset. And I got it through AppSumo, which was nice because I bought it one time and hope maybe they still have it there and I never have to use it again. But it has a to-do list every single day and you can create reoccurring tasks, which is nice because like Monday, Tuesday, Wednesday, I might have the same things that I do in my business. Maybe it's record a podcast episode. Maybe it's hold a sales meeting with the team, something along those lines. So what I do is every Friday, I'll spend about an hour, hour and a half, and I'll go through and chart down everything that I need to get done for the next week. And that way I'll have it on my Monday, Tuesday, Wednesday, Thursday, Friday planned out. And then Thursday, Friday, there won't be as much. Just I don't like to put as much on Thursday and Friday. That way, if I don't get anything done on Monday, I can move it to Tuesday. If I don't get it done on Tuesday, I can move it to Wednesday. So that's really how I like to structure my day, with Monday really being the most important tasks. And then Friday being the day where it's like, okay, if I get to this task, good. If I don't get to this task, it's not the end of the world. So I really like to take like on Fridays, just structure the entire next week. And it's been very nice using the Before Sunset. I say it's an app, but it's more just a website that I use. And it's just been very beneficial for me. Now, when I do my sort of morning routine, it works in with my strength training routine or my working out routine, where what I do now is I'll get up at 4:50. I get to the gym by 5:30. The goal is to get home from the gym by 7. And then that's usually about the time that my daughter is waking up. So she gets up about 7. I'll cook her breakfast. And then once that's all done, drop her off at daycare. And then for right now, I'll do like the marathon training runs. So I'll go through, I'll do those. And then when I get back from that, I'll journal a little bit, I'll meditate, and then I'll read in a book, maybe 15 to 20 minutes. I wish I had more time doing that. I just found it would just cut so much into the workday by doing that. So I'm more listening to podcasts while I work out, but I like to read there as well. So I like to get all those done where I can start working about 9:15 in the morning. So I've already done my training where, yeah, it's not the easiest, like running after working out within 2 hours, but I would prefer not to run at the end of the day because my daughter gets home from daycare at 4. And when I was really starting to running, I was running in the summer. So I wanted to run in the mornings anyways. I don't want to be running when it's like 90, 95 degrees here in New York in the hot sun at 4 o'clock in the afternoon. And the one tweak I had to make was on Saturdays when I've been training for this marathon and doing these long runs, is I would get up at like 4:15 in the morning and go out and run. That way I could get back by like 7:30. So again, I could get back for when my daughter would get up. But that was definitely challenging. Just I'd be running about 2 hours in the or for the first 2 hours in the countryside, pretty much in the pitch dark. And it was definitely a little interesting at times. I mean, I wouldn't even see a car for maybe the first hour and a half of me going on those runs in the pitch dark. I mean, I had a headlamp and whatnot, but I think it was just making that priority when it came to making sure I could get back in time for her. And that's been a big thing throughout all this training, is I want to make sure I spend enough time with her and that I'm not sacrificing my family time to train, where, yeah, maybe if I'm training for this big Ironman event, it might come up, but I try to structure it around really her schedule and when she's going to be home from daycare and when she's at daycare. That way I can try to get everything in so I don't have to do too much when she is home.
Love it. Love it. Yeah. And how old is she?
She is about to be 16 months.
Good for you, man. Yeah, that's cool. That's dedication. And that's a big thing with me, is like, there's, yes, doing what we're doing, we're going to have to sacrifice sometime, here and there. But like, again, going back to your why of why we're doing all this, right, is so I can be present with my family, right? Because at the end of the day, that's what matters most, right? My kids, my wife, and so yeah. I thanks for walking us through that, Trevor. And yeah, love what you're doing, man. And I know the work involved there, especially doing a hard workout and then an hour and a half workout and then doing a 2-hour run. So good for you. And then, all right, if you could be remembered for one thing, what would that be?
I would say probably just always being there, showing up for my family. I know it pretty much echoes that previous point, where I just want to make sure that I'm always around for my daughter on the occasional day where she has to come home from daycare early because she's sick, or they call her unfit for daycare on occasion. That can be annoying at times, but nonetheless, we have to pick her up at 10 or 11 in the morning, where I'm able to get that flexibility. If we have to take her, as an example, take her to gymnastics tonight, which is a whole process within itself, taking a 16-month-old to gymnastics, but just making sure that I'm always showing up for her and making sure, like, if she's home at 4 or 5, yeah, maybe I have to answer the occasional email, but I'm not on my computer the entire night. Or when I'm at her events, if I'm taking her to gymnastics or swimming, that again, I'm not on my computer just answering emails. So I think I just want to be remembered for someone that was always there and that she can always remember, like, hey, like my dad was always at all my events. And then not only was he there, but he was also present at my events. He wasn't on his phone. He wasn't on his computer. And yeah, I think that's really the biggest thing for me.
That's awesome, Trevor. That hits home with me, man. Because like for me, the biggest, most important thing is at the end of my life, I want my son and my daughter to say, "Dad was there. He showed up."
Mhm.
And again, not just physically, mentally too. He was present in all these events. So that's awesome, bud. Well, Trevor, if you could tell the audience where they can connect with you. Again, Trevor's got a great podcasting company where he really helps, get the word out and get great guests on. So if you could, again, tell listeners where they can connect with you on that.
Yeah, most certainly. Then go to our website, podcastingyou.com. That's podcastingyou.com. Or feel free to connect with me on LinkedIn. That's just going to be under my name. Very active on there and happy to connect with anyone and chat there as well.
Yeah, cool. And then if somebody's just looking to maybe pick your brain about investing and stuff, is it okay if they connect with you as well?
Yeah, that's perfect. Always happy to chat, whether you're working with our company or whether you're just a passive investor looking for some help. Happy to chat with you as well.
Awesome. Well, again, thanks for being on the show with us today, Trevor. Really enjoyed, you walking us through your journey and how you got, to where you're at today and how for me, I love just how you talked about the family aspect and again, that healthy work-life balance, because again, that's the most important part at the end of the day. Yeah, these accolades and what we're doing are all gonna, all great, with plaques on the wall and stuff, but how are we showing up for our family? So love that, Trevor. And yeah, thanks, man. Wish you well on your marathon there.
Thanks.
All right. Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.